Hey there, everyone. Welcome back to the channel. Today, we're diving into the recent market turmoil and the impact of AI on global stock markets. Specifically, we're focusing on South Korea's Kospi share index, which took a nosedive, dropping over 8% in a single day. This isn't just a blip, it's a significant shift in investor sentiment, and it's all tied to the ever-evolving world of artificial intelligence. Now, let's break it down. The Kospi's decline was led by a massive drop in SK Hynix shares, a South Korean chipmaker. Despite a six-fold increase in operating profit to a record high, the market wasn't impressed. This isn't the first time AI-related stocks have taken a hit. It's a recurring theme. The issue here is that the market is becoming increasingly skeptical about the sustainability of AI-driven growth. Investors are starting to question whether the hype around AI is justified, especially when it comes to companies like SK Hynix, which are heavily invested in this technology. This skepticism is not limited to South Korea. Other Asian markets, like Japan's Nikkei 225 and Taiwan's TAIEX, also saw declines. Interestingly, the Shanghai Composite Index in China managed to buck the trend, rising 0.5%. This contrast highlights the regional variations in investor sentiment and the impact of local factors, such as the recent earthquake in Japan, on market performance. Now, let's zoom in on the AI sector. The market's reaction to SK Hynix's earnings report is a perfect example of the challenges AI companies face. Despite impressive growth, the market's focus is on the potential for a slowdown. This is a common issue for tech stocks, where the market often reacts more to the fear of a downturn than to actual positive news. It's a classic case of the sell the news phenomenon, where investors take profits when good news is announced, fearing that the market has already priced in the positive outcomes. What makes this situation even more intriguing is the broader market context. While the Kospi and other Asian markets took a hit, the S&P 500 and the Dow Jones Industrial Average in the U.S. managed to stay relatively stable. This divergence in performance suggests that the market is becoming more selective, focusing on companies that can demonstrate tangible, long-term growth. In the case of AI, this means that investors are looking for companies that can prove their technology's value beyond short-term hype. In my opinion, this shift in investor sentiment is a wake-up call for the AI industry. It highlights the importance of delivering tangible results and managing expectations. Companies that can demonstrate the practical applications of their AI technology and show consistent growth will likely be the ones that thrive in this new market environment. On the other hand, those that rely solely on hype and fail to deliver may find themselves in a challenging position. So, what does this mean for the future of AI? Well, it's a reminder that the market is a fickle beast. It's driven by emotions, fears, and expectations, and it can be quick to shift its focus. For AI companies, this means that they need to be more transparent, focused on long-term value, and prepared to navigate the ups and downs of the market. It's a tough balance, but one that's essential for success in this rapidly evolving industry. In conclusion, the Kospi's decline and the broader market reaction to AI stocks is a fascinating insight into the current state of the market. It highlights the challenges and opportunities that AI companies face and the need for a more nuanced approach to investing. As always, the market is a complex beast, and it's up to us to understand its intricacies and make informed decisions. Thanks for watching, and I'll see you in the next video.